silver prices collapsed below $100 during Asian trading hours, while American investors slept, creating what market participants are calling the overnight massacre. This wasn't ordinary market volatility or gradual price discovery through normal supply-demand dynamics. This represents systematic destruction of leveraged positions through coordinated algorithmic selling that targeted specific technical levels when Western markets remained closed and liquidity stood at daily minimums. Understanding this overnight carnage requires examining the precise timing and mechanics that created perfect conditions for maximum price damage with minimal resistance. Asian trading sessions typically experience reduced silver trading volume compared to New York and London hours. Lower volume means individual large trades create disproportionate price impacts, while fewer participants remain available to provide buying support during selling waves. The dollar index surge that triggered the silver collapse began during European overnight hours, when currency traders responded to Federal Reserve communications suggesting more aggressive monetary tightening than markets had anticipated. DXY climbed through critical technical resistance levels that algorithmic trading systems had programmed as trigger points for systematic precious metals, selling across multiple timeframes simultaneously. Modern precious metals markets operate through interconnected algorithmic systems that execute predetermined trading strategies based on technical indicators, correlation relationships, and volatility parameters. When the dollar index breaks above specific levels, these systems automatically generate silver selling orders regardless of silver-specific fundamental conditions or supply-demand considerations affecting physical markets. The cascade effect began when initial DXY strength triggered momentum-following algorithms that increased silver short positions while simultaneously activating stop-loss orders from existing long positions. This dual pressure created accelerating downward price momentum that activated additional algorithmic systems designed to capitalize on technical breakdowns and momentum continuation patterns. High-frequency trading systems amplified the decline through microsecond-speed transactions that occurred faster than human traders could process information or respond with countervailing orders. These automated systems executed thousands of small selling transactions that created the appearance of massive selling interest, while actually representing coordinated algorithmic strategies rather than genuine supply-demand imbalances. The liquidation massacre particularly affected leveraged paper silver positions held by retail investors, small hedge funds, and commodity trading advisors who utilized margin to enhance position sizes beyond what their capital could support through extreme volatility periods. When silver prices declined rapidly, margin calls forced immediate position closures regardless of fundamental investment merit or longer-term outlook considerations. Leveraged investors typically set stop-loss levels below $100, thinking this psychological support level would provide protection during normal market corrections. However, algorithmic systems specifically target these obvious technical levels, knowing that stop-loss clustering creates opportunities for maximum position destruction with coordinated selling attacks designed to trigger systematic liquidations. The paper-silver market structure enables massive price manipulation because futures contracts and derivative positions represent claims on silver quantities that far exceed available physical supplies. COMEX silver open interest often exceeds 1 billion ounces, while global above-ground silver inventories total approximately 2 billion ounces, including industrial stockpiles and jewelry that cannot be easily mobilized for delivery. This mathematical disconnect between paper claims and physical availability means that paper prices can deviate substantially from physical market conditions during periods when normal arbitrage relationships break down. Large institutional players understand these structural vulnerabilities and deliberately exploit them during low liquidity periods when maximum price damage can be inflicted with minimal capital deployment. Individual investors became exit liquidity for sophisticated institutional players who used the overnight period to close short positions accumulated during silver's advance above $100. These institutions understood that retail investors would panic when prices broke below psychological support levels, while most Americans remained unaware that liquidation was occurring during Asian hours. The exit liquidity mechanism operates when institutional sellers find ready buyers at progressively lower prices as retail investors attempt to average down their positions or purchase what appears to be silver at discount prices. However, these retail purchases provide liquidity for continued institutional selling rather than genuine accumulation by knowledgeable investors seeking long-term positions. Professional trading desks coordinate selling campaigns across multiple time zones to maximize impact while minimizing resistance from informed buyers. Asian hours provide optimal conditions for such campaigns because Western institutional buyers who might provide price support remain absent, while Asian buyers typically focus on local equity markets rather than precious metals trading. The government shutdown implications create additional market vulnerabilities because reduced regulatory oversight and limited official market surveillance during shutdown periods enable more aggressive manipulation strategies. Government agencies responsible for monitoring commodity markets operate with skeleton staffs during shutdowns, while enforcement capabilities become significantly reduced. Economic data releases face delays during government shutdowns while creating uncertainty about fiscal policy and debt ceiling negotiations that historically affect precious metals markets. This uncertainty encourages speculative positioning that increases market volatility while creating opportunities for sophisticated players to exploit retail investor confusion and poor timing decisions. Upcoming macroeconomic calendar events, including Federal Reserve policy announcements, employment data, and inflation reports, create additional volatility catalysts that algorithmic systems exploit through coordinated attacks on technical support levels. These systems analyze scheduled event timing to maximize disruption during periods when markets face multiple uncertainty sources simultaneously. The mechanical relationship between global trading sessions creates predictable patterns that sophisticated traders exploit, while retail investors typically ignore session-specific dynamics. Asian sessions often experience lower volumes and reduced institutional participation, while European sessions typically show moderate activity levels. New York sessions generally provide maximum liquidity and institutional participation. Understanding these session dynamics becomes crucial for precious metals investors because pricing anomalies and manipulation attempts typically occur during transitions between sessions when liquidity gaps create opportunities for coordinated attacks. The overnight period between New York close and London open represents particularly vulnerable timing for such manipulation strategies. Currency relationships drive precious metals pricing more directly than most investors realize because precious metals are priced in dollars while purchased by investors holding various currencies worldwide. When the dollar index strengthens rapidly, it immediately affects the relative cost of precious metals for non-dollar investors while triggering algorithmic selling systems calibrated to currency strength indicators. The DXY surge that triggered silver's collapse reflects broader currency market dynamics, including European central bank policy divergence, Bank of Japan intervention concerns, and emerging market currency pressures that affect global liquidity conditions. These currency flows impact precious metals markets indirectly through their effect on dollar demand and international capital allocation decisions. Interest rate differentials between major currencies influence carry trade strategies that affect precious metals demand through portfolio allocation decisions. When dollar interest rates increase relative to other currencies, it encourages capital flows toward dollar-denominated assets while reducing demand for non-yielding assets, including precious metals that don't provide interest income. The correlation between DXY strength and precious metals weakness operates through multiple transmission mechanisms, including reduced international demand, increased storage costs denominated in local currencies, and systematic selling by currency hedge funds that use precious metals as dollar hedging instruments. These correlations become particularly pronounced during periods of rapid currency movements. Timing considerations become critical for precious metals investors because markets operate continuously across multiple time zones, while individual investors typically monitor positions during limited hours. Professional traders exploit these timing gaps, while retail investors miss crucial market developments that occur during their sleeping hours or work schedules. The global nature of precious metals markets means that significant price movements can occur during any trading session while creating conditions that may not be apparent until other sessions open. Asian economic developments can trigger precious metals selling that continues through European and American sessions without retail investors understanding the original catalyst. Electronic trading platforms enable continuous precious metals trading across all time zones while creating opportunities for algorithmic manipulation during periods when human oversight becomes minimal. These systems operate without regard to traditional business hours while exploiting liquidity gaps and reduced supervision that occur during overnight periods. Professional precious metals traders monitor multiple indicators simultaneously, including currency movements, interest rate changes, geopolitical developments, and technical chart patterns across different time frames. This comprehensive approach provides early warning systems for potential market disruptions while enabling appropriate defensive positioning before manipulation attempts begin. The mechanical relationships between different markets become apparent through correlation analysis that reveals how currency strength immediately affects precious metals pricing, while bond yields influence investor preference between yielding and non-yielding assets. Understanding these relationships enables anticipation of precious metals price movements based on developments in related markets. Liquidity patterns create predictable vulnerabilities that sophisticated traders exploit through coordinated attacks during specific time windows when resistance becomes minimal. The transition period between major trading sessions provides optimal conditions for such attacks because normal market makers and arbitrage traders often reduce activity during these transition periods. Market structure analysis reveals how algorithmic trading systems dominate modern precious metals markets while creating artificial volatility through systematic strategies that operate independently from fundamental supply-demand conditions. These systems respond to technical indicators and correlation relationships while ignoring physical market conditions or long-term investment considerations. The paper-to-physical ratio in silver markets creates structural vulnerabilities that enable massive price manipulation through relatively small amounts of capital deployed strategically during low liquidity periods. Physical silver demand may remain strong while paper prices collapse due to algorithmic selling that overwhelms normal market absorption capacity during specific time windows. Delivery considerations become important during extreme paper market volatility because physical markets may not reflect paper price movements when normal arbitrage relationships break down. Retail investors focusing on paper prices may miss opportunities to purchase physical silver at prices that don't reflect true supply-demand conditions in physical markets. Storage and insurance costs for physical silver remain stable regardless of paper price volatility, while providing protection against the manipulation strategies that affect leveraged paper positions. Physical ownership eliminates counterparty risks and margin call possibilities while providing direct exposure to long-term silver supply-demand fundamentals. The educational aspect for precious metals investors involves understanding that following silver prices in isolation provides incomplete information while missing the broader market dynamics that actually drive price movements. Currency relationships, timing considerations, and global session mechanics provide more reliable signals for anticipating precious metals price action than silver-specific analysis alone. Professional investment approaches incorporate multiple indicator monitoring, including dollar strength, interest rate movements, geopolitical developments, and technical analysis across different time frames and markets. This comprehensive methodology provides better risk management capabilities while enabling more informed positioning decisions than simple precious metals price following. Risk management strategies must account for global trading session dynamics and algorithmic manipulation potential while maintaining appropriate position sizing that can withstand extreme volatility without forced liquidation. Conservative approaches that avoid excessive leverage provide better long-term results than aggressive strategies that attempt to capture maximum gains during volatile periods. The psychological aspects of overnight market movements create additional challenges because investors wake up to substantial losses without understanding the manipulation mechanics that created adverse price action. This psychological shock often leads to emotional decision-making that compounds losses while providing additional exit liquidity for professional traders. Market education should emphasize the importance of understanding interconnected global markets rather than focusing on individual asset classes in isolation. Precious metals investors who understand currency dynamics, session timing, and algorithmic trading patterns achieve better results than those who rely solely on precious metals specific analysis or fundamental supply-demand research. The technological infrastructure that enables continuous global trading also creates vulnerabilities that didn't exist in previous generations when markets operated through traditional floor trading during specific business hours. Modern electronic markets never close while creating opportunities for manipulation strategies that exploit time zone differences and reduced human oversight during certain periods. Regulatory considerations become important because oversight capabilities may be reduced during specific periods, including government shutdowns, holiday periods, or budget constraints that affect surveillance resources. Sophisticated traders understand these regulatory gaps while timing manipulation attempts to coincide with periods of reduced official monitoring and enforcement capability. International coordination between regulatory agencies becomes difficult when manipulation occurs across multiple time zones and jurisdictions, while each authority focuses primarily on activity within their specific geographic region. This coordination challenge creates opportunities for cross-border manipulation strategies that exploit jurisdictional gaps and regulatory limitations. The historical precedent for overnight precious metals manipulation shows repeated patterns where significant price movements occur during Asian trading hours, while Western investors remain unaware until markets reopen. Understanding these historical patterns provides context for recognizing manipulation attempts while developing appropriate defensive strategies. Emergency response capabilities for individual investors become limited during overnight hours when normal support systems, including broker customer service, market analysis resources, and professional advisory services, operate with reduced availability. This creates additional vulnerabilities that sophisticated traders exploit, while retail investors lack access to information and assistance. The long-term implications of algorithmic market manipulation extend beyond immediate price impacts to encompass broader questions about market integrity and the effectiveness of current regulatory frameworks designed for traditional trading environments. These structural issues require systematic reform rather than individual investor adaptation strategies. Technology evolution continues creating new manipulation possibilities, while regulators struggle to keep pace with rapidly changing market structure and trading methodologies. This technological arms race between sophisticated manipulation strategies and regulatory response capabilities creates ongoing challenges for maintaining fair and orderly precious metals markets. Understanding the overnight silver massacre provides crucial education about modern market realities where prices can be manipulated through algorithmic coordination during specific time windows when resistance becomes minimal. This knowledge enables better investment decisions while providing realistic expectations about precious metals market behavior during volatile periods. The broader lesson extends beyond precious metals to encompass all global markets where similar manipulation mechanics operate during periods of reduced liquidity and oversight. Investors across all asset classes benefit from understanding how professional traders exploit structural vulnerabilities, while retail investors typically remain unaware of systematic manipulation strategies. This analysis examines observable market mechanics and manipulation strategies rather than providing specific investment advice or predicting future price movements. Understanding these dynamics provides educational context for recognizing market manipulation while developing appropriate defensive strategies that account for the realities of modern algorithmic trading environments and global session dynamics.